Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing in that specific order. Today is Tuesday, December 17th, 2024. Today's episode begins with a macro reminder. Watch yesterday's show, the 3-month 10-year Treasury yields finally reverted after 2 years. That show is titled Friday the 13th, even though it was my Macro Monday show, and it has a tornado in it. I'll bring it up again when we get to the daily reminders, but I want to start with this. This is the most important thing going on right now. Second thing on the agenda, Nissan stock. I bought more today before the news. If you've been following the show, you might know that I'm very bullish on Nissan stock, considering that its balance sheet appears to be very rich compared to the stock price. There's a big mismatch. If you were to liquidate the company today, I believe the stockholders would be paid a lot more than what the current stock price reflects, making it a bargain cigarette, but perfect Ben Graham deal. And I was a little scared of it dropping down to $4.40 today, and I said to myself, no. I looked at the numbers, I've studied this, I understand what I'm doing, and news broke. Suddenly, when things become this cheap, I'm not the only person with enough intelligence to see the value of companies out there to perhaps come in and offer a deal. And this is what happened today. That's the news on Nissan. We ended up going up 12% on the back of this news after this morning. The price looked like it was going basically to zero. And I bought a bunch of shares. And I'm really glad that I did. There were rumors of this around the internet, and we're finally seeing it now. Honda and Nissan reportedly start merger talks. When a company's current assets almost cover the entire liabilities of the company, I don't care if the debt to equity ratio seems kind of ridiculous. To me, that just means that the share price has gotten insanely low in light of the fact that, this company has land, it has equipment. If you were to liquidate it, the stockholders would be perfectly fine as it stands right now. This company is clearly not worth nothing, and it's being priced like it's going to go bankrupt, and it clearly is not on the path to bankruptcy in my mind. I mean, the worry has been that, okay, they're projecting into the future. Oh, we're worried we're not going to sell enough cars, and if that happens, then we're going to lose all of this money. I mean, I hate to say it because I don't think the company is participating in this, but there is something called a poop and scoop. It's the opposite of a pump and dump. Sometimes what you'll have is people like Jim Cramer out there going out there on TV and saying, oh, hey, you got to buy this stock, buy this stock, buy this stock, and then he'll short it. And he's been recorded saying that he had done that in the past. It's called a pump and dump. You tell everybody, buy this stock, and then while they're buying it higher in prices, you're either selling it or you're shorting it. There's something the opposite called a poop and scoop. I know it sounds funny, but where they try to make the news sound as bad as possible to get the price as low as possible, and then to get everybody scared, because the price has never been lower for Nissan stock in its entire history. And so people that are selling these shares are losing or have been losing enormous amounts of money. Lots of money has been lost to people like me who are scooping up these shares, knowing that the company obviously has more value to it, and I'm not the only one to see that. Honda sees it, and now we have talks of mergers. I mean, if I had enough capital, I would buy the entire company today, and I would liquidate the entire company today, and I'd make a good profit. That's what I would do. I don't have that kind of capital, and I figured there's got to be people out there, entities. In this case, it's Honda, that looks like it's going to, let's say, increase stockholder confidence in what's going on. And yeah, so Very exciting. I was very excited to see it pop 12% after. I didn't look at markets all day, only briefly in the morning, seeing it at that really low price and then up 12% today. But I'm not surprised, and I'm glad. I'm very happy I'm able to use what I learned from Ben Graham's security analysis in real life and take advantage of it, because this is clearly playing out to my favor at this point. Just to take a look at the chart really quick, the wick got down to $4.41 today at one point before the news broke out, and then we rose to $5.37, ending the day at $5.11. This kind of move, for better or for worse, is going to attract more investors, at least in the very short term, into this company. I, you know, because like psychologically, it's, when something people will see this on their radar. It'll pop up on a lot of people's radar. It's one of the best performing stocks of the day, going up 11.5%, and so I would imagine this gets a little bit of a bid, whether, not for the right reasons, of course. The right reasons are the fact that it's just undervalued and has way more value than it's been priced at. But, as far as technicals go, the psychology is there, and the price should be going to the upside. Again, my sell price, I think I said around the $9 range. I'll have to double check that. Yeah, it's still very cheap, but not like insanely dirt cheap. When it got down to $7 is when I started accumulating, and I've been accumulating this entire time. And yeah, so we'll see how it plays out. Next item on the agenda, EWZ. This is Brazilian stocks, just getting insanely cheap. I'm just realizing that today's the ex-dividend date, and so this chart probably reflects that more than anything else. Actually, it's a big dividend. It's a $1.10 dividend, so that's part of the reason it's low. But in general, we haven't seen this price this low since the COVID crash. And on top of that, going over to Yahoo Finance, EWZ, the yield on this is 8.4%. I mean, for an entire stock index of a country to have a dividend yield of 8.4%, all while the S&P 500 is at a PE ratio of 31, yielding relatively nothing. As time goes on, as inflation happens, the amount of money that is paid out to the shareholders automatically increases. And, for this to already be yielding that much at this price it's just such an insane, great opportunity. I might have to shift some of my Chinese exposure over to Brazil to kind of even them out. My original portfolio was actually 10% each. China took off to the upside, and so I might be rebalancing that soon, especially in light of EWZ dropping so much today and being at a price that we haven't seen since literally the COVID crash of 2020. I mean, again, these companies make stuff, they make money, and they actually pay the shareholders. They're not doing the kind of nonsense that you see in a lot of corporate America where they're just doing buybacks and the shareholders have no idea what's going on and what kind of, that they're adding essentially risk to their portfolios behind their backs. Anyway, moving on, CNBC headline coming out today. The Dow tumbles more than 260 points for a 9-day losing streak, its longest down streak since 1978. Now, these kinds of statistics are kind of like football statistics, right? Like, we haven't seen a pass followed by this happening and this happening. Like, you combine certain stats together, and like we haven't seen that for 20 years, 30 years. So, it's good to take it with a little bit of grain of salt, but this is certainly a crystal ball, little like, we'll call it flash, showing not super strength right now in stocks in general, with the Dow doing this. Not, I mean, setting, like it says. We haven't seen a 9-day losing streak since 1978, apparently, in the Dow. So it's notable at the very least, even if you should take it with a grain of salt. Later this week, tomorrow, we have the FOMC decision. It's at a 99% chance of there being a 25 basis point cut, so there's no point in speculating otherwise at this point. Thursday, we have GDP, a Q3 second revision. Yesterday, I mentioned incorrectly that it was at 2.9. I must have seen some like pre-estimate number that I had stuck in my head. It was 2.8 and then 2.8 for the first revision, and then so we'll see what the second revision comes out. Again, if it like ticks down, that could be another like more recessionary signal, which you tend to see going into recessions, is revisions to the downside. We also have Friday, the PCE data, personal consumption expenditures. This is the Fed favorite inflation gauge, which will give us a glimpse as to what's going to be happening with the next cuts, the next Fed meetings, and the Fed funds futures moving forward. So Friday will affect things for sure, although it won't have a lot of time. I mean, a lot of the pros go home. It's this Monday, right? Yeah, I believe so. Next week. Yes, Monday the 23rd is when the Santa Claus rally begins. And so, I don't know, if the PCE number really rocks the boat enough, maybe the pros will, do some movements. Like I said in Monday's show, if we're going to miss a Santa Claus rally, like I feel like this could be the year where that happens. So for today, none of the daily reminders have changed. Again, like I mentioned at the beginning of today's show, watch Monday's show titled Friday the 13th with a tornado inside the crystal ball. This video walks through my macro view, explaining everything that I think is massively important for any active investor, or I mean, at this point, any investor, anyone that's invested. The amount of speculative value going on in markets is so insane that, I don't think it's wise. I don't think it's wise. Even Ben Graham says never have more than 75% of your money in stocks. He says 75-25 should be the maximum. I'm inclined to say that may be especially good advice right now. One of the other things going on I find very notable, apparently, the retailer investors have never been more bullish in stocks, like ever, like in the history of mankind, apparently. And this is a huge signal that we're probably at the top right now. But anyway, I digress. The daily reminders haven't changed. Watch Monday's show if you haven't. The crystal ball readings also remain the same. No changes in my portfolio or crystal ball ratings. Although, as the price dropped on the Nissan stock, I'm just like filling it back up to 5%. And now it's probably above 5%. Moving on to the charts. I meant to include this chart in the first daily macro reminder section just to look at the U.S. Treasury yield curve. I love looking at this in a graph on a daily basis because it helps having the visual of it to see what's going on. And it's just clear as day right now that we are at that point where the front end is clearly dropping, with the 3-month now solidly below the 10-year. This is it. This is the reversion stage that I have been waiting for over 2 years, ever since we inverted. Granted, I knew from the beginning that markets can be bullish while yields are inverted for a long time, even though it's a signal that a slowdown is coming. But it doesn't come until you revert. I had no idea it would take 2 whole years for us to revert. I thought maybe 6 months, maybe 1 year. I did not think over 2 years. But we finally have made it. We finally made it to the point where there's a very, very high probability that there is a major recession or depression coming, and this is it. This is the front end. It's going down. Extremely exciting times in markets right now. The S&P 500 going notably flat. Whenever you have something going flat, the bigger the breakout eventually becomes. Are we going to pop up above that 6,100 level, which marks the top of connecting the 1929 bubble to the dot-com bubble? Or are we going to pop right through that and go even higher? As you know, there's people out there that believe we're going to go straight up to 7,000 in the SPX. Or is this the top? Me and my crystal ball say this is the top. I think this is it, especially in light of how bullish retail investors are. It's staggering how wrong the crowd can be, and when they're max bullish, this is like probably the best possible time to be bearish. That's the way I'm looking at it. I'm very confident, actually, this is the top here. But we'll see how it plays out. The VIX has been creeping up, popping up 8% today, still below that magic 20 mark where, above 20 is when volatility is actually high. I mean, it's going up. I don't know. Maybe we're preparing. I mean, we're obviously preparing for a bigger move. Again, this is the pricing of calls and puts. So, when volatility spikes, it can indicate a potential burst to the upside or to the downside. But the VIX is currently sniffing out more volatility than what the price of the S&P 500 is currently suggesting, going straight sideways. Last chart of the day that really caught my eye, XHB, Home Builders Index. We had some home data come out today. The whole year has not been very confident. There's been more fear in home building than bullishness for the whole year. And today's report didn't show any more strength. I mean, it's 46. It's like that 50 is like equal. Above 50 is confident. Below 50 is not confident. So, and that kind of added to the home builders already breaking through this previous trend line that we had been developing. This is looking straight up bearish at this point. And this can function also as a leading indicator that, other markets can follow after the fact. It's been really tumbling with a lot of momentum and without really bouncing. You'd think like some of these previous bottoms would provide a bounce, but there's no bounce. We've just been falling precipitously, like off a cliff here. All red candles, by the way. Since when did this start? November 26th. So for a few weeks now, just straight down, not even a bounce. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.